Very good morning, everyone. And I'd like to welcome you to this webinar event hosted by the RMIA New South Wales chapter. And I'd also like to welcome and thank our main event sponsor and presenter for today, being Catalyst Technologies. My name is Jason Smith and I'm a director with the RMIA. I'd just like to start off with a few housekeeping matters, if that's okay by you all. If you could all just put your screens on mute and your microphones on mute, and also okay to put your screens on pause as well, just to allow us to maximise the bandwidth and have some good quality audio and visual throughout the rest of the presentation this morning. But by way of starting, before I pass over to Nafisa and Penny from the New South Wales chapter, I'd just like to say a few words, and in particular, I'd just like to, again, firstly, thank Catalyst Technologies, Marcus and his team, with regards to not only this event, but this event represents essentially the start of our collaboration directly together. And I'm particularly excited about this collaboration insofar as whilst the RMIA already has some fantastic partners and collaborators and sponsors, this is a very unique collaboration that we've started off with Catalyst Technologies, insofar as the RMIA is normally very proud to bring to its members some fantastic knowledge sharing and thought leadership. And indeed, as you listen to Marcus over the next hour, that's exactly what you'll be receiving. But as RMIA members, you're going to be receiving a lot more from today onwards. And what do I mean by that? Through our collaboration agreement, Catalyst Technologies have agreed to provide every RMIA member with complimentary access to their Illumina platform. And Marcus will be taking you through, along with his team today, the fundamentals of the Illumina platform. And as a long-standing risk management executive myself, I'm really excited about this technology because I've seen a lot of other similar platforms, but I haven't seen anything like the quality and the caliber of the Illumina platform. And as you'll find out in terms of what it enables risk managers to do with regards to real-time tracking of peril and other crisis and business continuity events, in literally today's environment with what the East Coast of Australia is experiencing, it's very real and it's very live, and I'm sure Marcus will share some of that with you later on today. So again, on behalf of the RMIA, thank you to Catalyst Technologies for coming on board as one of our key sponsors, but also thank you insofar as something that's really new for the RMIA with regards to complimentary access to the Illumina platform to all our members. And one further piece of housekeeping, I'm sure you're going to have lots of questions for Marcus and his team to the presentation this morning, so please use the chat function on the Zoom session to put forward any of your questions to Marcus. And with that, I'll pass over to both Nafisa and Penny from the New South Wales chapter. Thank you.
Thank you, Jason. Hi, everyone. Welcome to the webinar today. Pretty exciting given our recent risks that we're currently experiencing, especially in New South Wales with the flooding and the heavy rain. So I'm sure everyone is pretty excited and want to hear more from our elite panelists. For those that I haven't had the privilege of meeting, I'm Nafisa Aziz, New South Wales chapter president for RMIA, and when I'm not assisting RMIA, I'm busy heading up risk, safety and compliance for Ampol Retail. Today, for our panelists, we actually have Penny Barker, who's also from Ampol, who will be facilitating. Penny heads up our environment and sustainability team at Ampol and is responsible for setting the business sustainability policy and strategy, including addressing climate change related risk. So I would encourage everyone to hop Penny and ask as much as questions as you can on climate change as well, because she's highly qualified in that area. Penny has over 20 years industry experience in sustainability and environment across a range of industries, including infrastructure, telecommunications, and energy sectors. Then we have on our panelists, Thomas Motlock, who Thomas is a senior risk scientist at Risk Frontiers, driving the development of physical climate risk, coastal flood and cyclone loss modeling services. Thomas has over 12 years experience, industry experience in the field of climate science, catastrophic risks and insurance, coastal and windstorm modeling. Thomas has also led multiple projects to help clients understand the financial impacts of physical climate risk. A great challenge that most of us in our organizations face is actually understanding the financial impacts of these current risks that we're facing. And then we have Marcus, as Jason mentioned, who is one of our sponsors for today's event as well. Marcus is a co-founder as well as the Chief Growth Officer at Catalyst Technologies, the company behind Illumina, working in the risk and resilience field for over a decade. Marcus has an area of experience in working with organizations across all industry sectors. He's passionate about tech innovation, sales, and client engagement with extensive experience in professional services, crisis, and risk management. Marcus previously led growth strategies for one of the world's largest insurance and risk advisors, Aon and Consultancy, which is from RiskLogic. So welcome to our panelists, welcome to our facilitator, welcome to all of the participants. Just to reiterate what Jason mentioned in terms of housekeeping, just two things. We will be using the chat function. So if you have any questions, even if you have questions throughout the webinar, don't leave it to the end, ask the questions. Penny, as the facilitator, will be moderating and keeping an eye out for any of those questions. Panelists, so welcoming as many questions as possible. Can everyone have the microphone on mute? So that will just help easily facilitate without any interruption, as well as trying to, if you're not on screen, I guess only the panelists and Penny will be showing the camera on screen, and that will also help with any quality issues we would have with the recording. Before I let you lead, Penny, just want to iterate two things. We're going to be sending through a post-survey event after the session, and I encourage everyone that has attended the session to provide as much as feedback as possible. It's only with this feedback that we're able to better any future webinars that we have. So any improvements you think we need to make, anything that worked really well, all of that you can input into the survey. And then once again, as Jason mentioned, RMIA members who sign up to the Illumina system will have additional benefits as RMIA members. But if you're a non-RMIA members, it's still free to sign up and work closely with the Illumina team to understand the benefits of the system. Really, really good system. Encouraging everyone to at least sign up because it's free and understand the system and how it actually helps with our current risks relating to crisis management, emergency management, and climate change. Okay, I think that's enough from me. I will hand over to you, Penny.
Thanks very much, Nafisa, for the introduction, and also to Jason for introducing the session. So I'm going to kick off with a series of questions for Marcus and Thomas, and then hopefully add some insights from the AMPOL perspective as well. We're going to run through a series of questions for the next 30 minutes or so, and then we'll leave time at the end for Q&A. And as Nafisa said, please feel free to sort of add any questions in the chat room, and we'll attempt to answer those at the end. So to kick off, just to sort of ask I suppose more of a contextual question for Marcus and Thomas. Just when we talk about the broader climate risk, what are we talking about when we talk about physical climate risk, and how might it affect a business?
Did you want to have a look at all climate risks to start with, Thomas, and maybe we zoom in on physical?
Yeah, sure. Yeah. Yeah, so thanks very much all for the invite here today. It's certainly very topical, as we've mentioned this week, experiencing the flooding in New South Wales and southeast Queensland. So hopefully we can tie in the conversation towards the tail end, towards present events. But just to give a bit of context to begin with, then, when we're talking about climate risk, we can really divide this problem up into three separate areas. So we have the physical risk, something else that's called transition risk, and then legal or litigation risk. So when we're referring to physical climate risk, we're really talking about the acute climate shocks, so extreme weather events, and the chronic climate stresses that act on individual assets in situ on the ground. So the effect of climate and weather on asset integrity, essentially. There's also another element to that, which is also supply chain risk. So the physical risk that can be transferred to your asset in situ on the ground through the supply chain by another provider. The second element to that is transition risk, which is really much more macro scale, looking at the sectors in an economy which may be the winners or losers in the transition over the next few decades towards net zero carbon economies. And then a really interesting area, I think, that's still very much in its infancy and evolving is but very much a driver, I think, at the board level for this, is the legal litigation risk that is posed by climate risk. And the precedents that have been set internationally over the past few years in that respect. I think probably just before handing over to Marcus, I think also we can look at this in a bit of a continuum. So the physical risk is probably the most crucial element when we're looking at the asset level. If we aggregate up to the organizational level, then transition and legal risk become probably more important. But very much in terms of my experience, focused on physical climate risk. Probably over the past few decades in certain sectors, this was previously known as natural hazard risk. A little bit more forward thinking now, perhaps, in terms of what's happening in the future, but very similar in that regard.
Yeah, I think just to add to that, Thomas, I mean, that's a really good kind of overview of that. I mean, why are we here talking about this today? I think obviously the events that have occurred over the last 5-6 days are one of those really harsh and brutal reminders that physical climate risk is certainly not going away. And as we move towards, I guess, a carbon neutral economy, we are going to continue to feel really volatile weather patterns. And we've seen some really interesting events over the last 6-12 months, right down to, if we zoom out a little bit and look at what's happened on the other side of the Pacific, zooming away from the floods for a moment, we saw Texas plunge into absolute darkness this year, where their state grid wasn't able to cope with the winter vortex that went through. California experienced its first gigafire. Obviously, again, we go back before COVID, and it feels like a million years ago now. But obviously, we felt the effects of Black Summer and the bushfire catastrophe we had in Australia. So, reality is that physical climate risk is obviously an immediate threat that is affecting us. Some headline stats: we had $268 billion worth of economic losses last year. I think the interesting factor out of that is that that insurance gap that covers that's widening. So that gap's growing, and so with that, organisations are feeling the brunt of it from not only a financial perspective, but obviously our communities are feeling it from a people perspective as well. As we look at some of those immediate impacts, like asset, right through to obviously the community implications that come with business interruption, recovery, supply chain disruption. So there we are. Physical climate risk is a long way to get there.
Thank you both for that introduction. So in just, I think the context that's happened in Sydney and across New South Wales sort of provides some context in terms of my next question was, what is the modelling currently telling us regarding the change in temperature and its effect on natural catastrophes?
Yeah, so I think probably just beginning at a very high level in terms of what the global climate models are telling us in terms of reconstruction of past temperatures. So there's a general consensus, a very strong consensus within the scientific, the climate modeling community, that the mean global temperature increase that's been seen over the past 150 years in observational records is very much driven by anthropogenic greenhouse gases. And we can have high confidence with that because we know that our climate models run over the historical period when we input everything, including greenhouse gases, into those models, replicate that mean state change very, very well. When we then rerun those models taking out the greenhouse gas forcing, then temperatures over the past 150 years since the Industrial Revolution almost flatline. So by inference, we can have quite high confidence that that residual temperature increase is related to greenhouse gas forcing. So that's probably the first point to make. The second one is, as I'm sure you're all aware, that when you get a mean state change in the climate system, you also get a shift in the tails. And so what's happening to the distribution, if you imagine a bell curve, is that the mean is shifting and actually the tails are also shifting with it, but the distribution is widening out as well. So what does that mean for extreme weather? It means that we overall are changing the probabilities of experiencing extreme weather events with a mean change in global temperature. And I would highly recommend, if you want to read in a little bit more detail about exactly what is the scientific consensus and the projections for Australia, the go-to report really is the Climate Standards and Measurement Initiative, the CSMI scientific report. And that's something that Risk Frontiers contributed to and is an Australian industry-led collaboration to assist with climate-related financial disclosures. And Australia is very much a multi-peril environment. There is no way you can only look at one hazard, as the past few years has certainly shown us. There are 4 or 5 major extreme weather events in Australia: fire, flood, hail, windstorm and cyclone. So just very briefly with tropical cyclones, the scientific literature to date suggests that we're expecting to see an increase in the frequency of Cat 4 and Cat 5 cyclones, so the most extreme ones, but actually an overall decrease in the number of cyclones forming within the Australian region. Rainfall, very apt at the moment. Projections suggest that a general drying out of the Australian mean climate, but an increase in extreme hourly to daily rainfall. So that really equates back through to an increase in the potential for flash flooding. Fire weather, high confidence associated with an increase in frequency of fire weather. East coast lows, a decrease in frequency is projected. And hailstorms and convective thunderstorms, very much unclear at the moment because they're so small scale, they're sub-grid scale when we're looking at climate models. So that's probably an overview, I think, of the extreme weather events. There are certainly a range of different confidence levels that are attached to each one of those projections. And then just finally, we can't forget the chronic climate stresses, of which there may be a large range that are pertinent to any signal business or organization, but essentially come back to temperature related chronic climate stresses or water related stresses. And sea level rise being one of them only contributes, even if everything else stays the same, only contributes to a change in the impact from coastal extremes such as east coast lows and tropical cyclones.
Thank you, Thomas. That's a really good overview. Moving on to the regulatory context, and so what we're seeing in the UK and Europe in terms of regulatory changes there, what types of things should organisations in Australia be preparing for in terms of managing physical climate risk?
Yeah, so that's a really good question, and I think really internationally it all kicked off really with a now famous speech by Mark Carney of the Bank of England in 2015, which coined the phrase tragedy of the horizon, which I think sums up this whole climate risk issue really, really well, because especially for physical climate risk, up until past few years ago, it has always been a potential risk that is on the horizon for businesses. That is not traditionally incorporated into business risk management, enterprise risk management. But that all changed, especially with the TCFD. So the TCFD is the Task Force on Climate-Related Financial Disclosures, and in June 2017, they released the final recommendations were published. So for those of you that don't know, the TCFD is still a non-statutory framework for the disclosure of reporting of climate-related financial risks. And within that, there are four key themes: governance, strategy, risk management, and metrics and targets. And there's evolving recommendations and guidance around how organisations should report and disclose against the TCFD framework. At the present time in Australia and internationally, this is the widely adopted framework, and the signatories to that just keep increasing. But definitive guidance, standards and regulations are still yet to come. So I think at the moment disclosures are very much open to interpretation of that framework, but there certainly is regulation around the corner and strong signals of that internationally and in Australia. So over the past few years, APRA, the Australian Prudential Regulation Authority, and ASIC, the Australian Securities Investment Commission, and the RBA have all signalled that climate risk is A, material, and B, actionable for those organisations that they regulate, and that guidance and regulation is being prepared and is underway at the moment. So I think that at the moment, there certainly is an increasing uptake of the TCFD framework. There's an anxiety there, I think, that what organisations are disclosing, how they're disclosing that at present time will conform to upcoming regulation. And probably just lastly, in the past few months, the Bank of England have released some detailed guidance on stress testing and scenario planning for banks, which will inevitably flow through to here quite soon. And also in the UK, the PRA, the Prudential Regulation Authority, similar to APRA here, has already mandated that global banks domiciled in the UK need to include climate risk in their business modelling within the next 12 months, and basically a show cause for that. So things are moving very quickly. Everyone's expecting some kind of standardization of disclosures, which is very much, I think, needed at this stage. But it is moving at a pace of knots at the moment. Still a very young area, but a wide uptake at this present time.
Fair to say, though, Thomas, I guess just coming off the back of the conversations we're having with organisations over in the UK, it almost feels like if you want a vision into the future, go and talk to your, I guess, your counterparts in the UK or your peer group in the UK in terms of what's coming next.
Yeah, I think so, and a lot, with a lot of these big organisations in the financial services sector, they are global markets, so they may be domiciled in one country, but will have branches and operations globally. So it very much is a globally connected network. But yeah, I would say at present time, probably the UK and Europe is 6 months ahead, perhaps, of Australia. I do also note that New Zealand has become the first country in the world to in 2023 will ensure that climate-related financial disclosures for New Zealand-based organisations will become a legal requirement. So very much moving in that direction globally at the moment.
So from the AMPOL perspective, we've obviously adopted the TCFD framework and going down a path of implementing that, including putting good governance in place, at the board level and management level around climate-related risk. Again, I think from a transitional risk perspective, we're starting to feel more comfortable around how do we understand that. But the other thing is, how do you actually manage physical risk, and sort of having some good examples out there to look to is kind of, I suppose, a little bit of our struggle at the moment. So from both your perspective, Thomas and Marcus, what industries or segments do you believe are leading the way in terms of managing transition and physical risks?
Yeah, Marcus, do you want to go first on this one?
I mean, I'll talk to it more from a physical risk perspective, which is, I guess, probably the space we play most in. I think first and foremost, if you zoom out, financial institutions or financial services is absolutely ahead of the curve on that front. I think insurance companies have been dealing with physical climate risk as part of their DNA, since they, came to fruition. So I'd say they're well and truly ahead of the curve. We are seeing, I think, banks, even some of the second tier financial institutions step up pretty quickly on this front as well, in terms of taking forward leaps. It was really interesting to watch CBA only in the last week or two launch some technology that goes beyond just looking after their own people, actually supporting customers on physical climate risks, so speeding up, much to what an insurer would naturally do as part of their business model. But the banking sector is now looking at it and going, that's a space to not only support, but I think about it from a growth perspective, probably retain customers, to be perfectly honest. So they're absolutely at the forefront. Some of the high hazard industries are coming up very quickly in terms of taking some of those forward leaps, and adoption of new techniques and technology. Construction is definitely out there. Just, I think, probably a natural impact they would incur from a physical risk perspective probably puts them out there as well. I would say, if there's any standouts, they would probably be from my perspective. Thomas, I'm interested in your take from a modelling point of view, and I guess identification analysis perspective.
Yeah, no, I'd pretty much agree with everything you said there, Marcus. I think certainly with insurance, having already had decades of experience in managing and pricing natural hazard risk, kind of puts them a little bit, in front of the curveball of other sectors potentially at the moment. And the work that we've been doing over the past several decades has essentially been developing these models called catastrophe loss models, which look to translate the financial impacts for insurers and reinsurers of extreme weather. So they're very much, they have a very innate understanding, I think, of extreme weather risk, which puts them in a good position to look more long term. And traditionally, I think insurers have a very short-term view. So just because premiums can be rewritten on a 12-monthly basis, they are also very nimble. Having said that, reinsurance certainly does have an interest in climate risk a little bit more longer term than that, because of this whole insurance affordability piece and investing and divesting in certain areas and sectors. With regard to banking and other sectors, still, I think, very much in its infancy. I think there are some really big opportunities for transferability between the type of modelling that insurance has been doing for some time now and the applicability for banking, and looking at default levels on mortgage books, for example. In fact, we were speaking with one of the large banks a couple of days ago, and it was an interesting framing of the problem that they almost see insurance affordability as a transition risk for them. Looking at their default rates on loans and mortgages out for the next couple of decades. But I think more broadly, again, echoing what Marcus said, if you're looking at the official supporters of TCFD in Australia, it's risen from about 10 at the end of 2017 when TCFD recommendations first came out, to almost 80 now. And there's certainly accelerated growth over the past 6 months. So it's going to continue growing more than that. If you look across the sectors of those signatories, and this is probably just a small sample of those who are actually disclosing their financial related climate risks, the vast majority, over half, are from the financial services sector. So asset managers, whether that be banks, superannuation funds, etc., with a small number from communications, energy, real estate, transports, utilities. So a very broad base, but as Marcus said, I think probably the standouts at the moment are financial services, and we have a lot to learn, I think, from the insurance sector.
And what are some of the challenges facing businesses to understand physical climate risks on their business, do you think?
Yeah, so I think probably coming at it from the climate science perspective, I know one of the challenges are that the climate models there are questions being asked of the climate models at present that the climate models don't necessarily have the resolution to answer. And I can give an example here that if we are looking at the incidence and the frequency of extreme weather events at a point location at an asset, the climate models may be operating at best at the most highest resolution that we have across Australia, which is NARCLIM, which is managed by the New South Wales government, is 10-kilometre resolution. So the 90th percentile of a weather event within a 10K grid box is certainly not the same as the 90th percentile at an asset location. So the upshot of this is that climate models often underestimate the incidence of extreme weather events. So there needs to be a kind of a translation piece here where we can responsibly use the climate data at hand. And there are ways and means of doing this to answer some of the detailed questions being asked of that data. I'd probably say that's the first one. And then the second one also would be breaking down, I think, a bit of this black box culture in terms of climate data analytics, really being open and transparent about where that data is coming from, the uncertainties around that data, and what it really means for your business.
Yeah, I think just to add to that makes a huge amount of sense. I think from my perspective, watching organisations probably grapple just with the change of how their organisation now operates. So what my organisation looked like in 2019 is not what it looked like in 2021. Like that's just an absolute, fact. And I think you could apply that to probably 90% of organisations across the world. So I think as we continue to grapple with, I guess, the change in our operating rhythm, we are now dealing with what feels, it's hard to read a newspaper and not see the word unprecedented when they talk about weather in the last 12 months. So it feels like we're dealing with more events that we've never experienced before on the scale that we've ever experienced them before, in a totally new operating environment where teams are literally strewn everywhere. Critical functions have changed, critical points of failure have changed. And I guess the need for response on exactly what's happening has sped up. And then you compound that with, I guess, a 24/7 media cycle about what are you doing about this. And most teams are, feeling it, absolutely feeling it. There's no doubt, probably every risk manager in the room today would be I guess, reflecting on that over the last 12 months. And I think with that, the big challenge that comes with that is compounding events, and then you overlay COVID. Thank you, COVID, where literally every crisis team, not in Australia, but around the world, is fatigued. Let's go back. Not 12 months, 18 months. We went through droughts to bushfires to COVID kicking off to recession and watching the news with lineups around the block to get into Centrelink, to severe storms. And then, we had an absolute corker of a hurricane season over in the Atlantic. So, our friends and colleagues over in the States, and I know a lot of risk managers that have operations over there as well, went through a huge amount of pain there, where they had a near record hurricane season coupled with tornadoes, all whilst managing COVID. So yeah, it's a different operating environment, and I guess that's the conversation today as well. Like we're experiencing challenges that the old playbook doesn't seem to work for anymore.
That's a good segue, Marcus, into the next question. 2020 was obviously the year of unprecedented. So what are some of the sort of standard observations of how organisations have performed and changed to manage those challenges?
Yeah, I think, the biggest outstanding observation, and the fact that we're doing this remotely is probably a great example of that, is just the prolific uptake of digital tools. So I think organisations went from, we will do digital transformation and we'll get there in a few years, to, okay, we now need to get there by April. So that was a big change and an observation. That it has, I guess, enabled organisations to become much more agile in how they manage any critical event, including natural catastrophe critical events. So organisations have become a lot more agile. The ones doing it well have become a lot more agile and a lot more connected, build networks that they can resolve issues doesn't always have to go up through a CMT, because they know the CMT might, say crisis management team. Sorry, I'm throwing in my own level of jargon there. The crisis management team might not always have the capacity to deal with every issue coming through. So I think, organisation, the observations are, the digital transformation component, those that are leveraging that are getting ahead of the curve. And I think at the moment, some risk managers will be in this space and some won't be, but there is certainly a massive rethink happening right now around critical event management, crisis management, and right through business continuity. In that, everything that we used to do doesn't seem to work. And the organizations that are, I guess, taking that next step and almost treating it like project management to a certain extent on steroids are certainly getting ahead of events much faster.
I'd probably just add to that also, it comes back to the point, I think also, that before you can really understand the impacts of physical climate risk on your business in 10, 20 years time, you need to get a good handle on what is your exposure to extreme weather and climate events today or historically on your business operations. And if you don't know that, you can't really have much of a hope about how that's going to change, what that delta value is going to be over your time horizon of interest. So that would certainly be a starting point, and there are ways and means where you can correlate observations of these extreme weather events to business continuity or asset value data. But I would say that probably is a first step, and there are some sectors there that really do understand their present day exposure to these kind of things. So you can go searching for those thresholds and parameters in the climate models and look at how they might change. If you don't know that, if you have no feel for what your exposure is presently, then you're almost looking blindly into the future. You really don't know, whether you're more exposed to floods or bushfires, whether your assets are at risk to storm surge and therefore sea level rise might be an issue. So that kind of first step, high level, perhaps even qualitative assessment is really important as a risk scoping stage before getting into the detail and looking at changes over your investment time horizons.
Okay, I've got one final question for you both before we open up to see whether or not there's any questions. So for both of you, what do risk managers need to consider to manage climate risk exposures moving forward?
Yeah, I'm happy to have a first crack at that. I think just, there was kind of a perfect segue, Thomas. I think getting a really good understanding of it's definitely step one, isn't it? I mean, from my perspective, I think, looking at, and like I said, the world I live in at the moment is a little bit more response, critical event management than it is, I guess, core risk management. But I think playing into what Thomas was just saying there, I mean, get an understanding of it and then start actually looking to build some agility in how you're going to manage that. I think, again, recent events have proven, and using the word unprecedented again, you can't plan for every nth of detail and every nth scenario, but what you can do is become really agile and build up really good processes that are malleable across the organization to get ahead of events, get advance warning on them, get your teams together to start working on them, and essentially get a process of understanding the exposure as it starts happening and responding really quickly. I think a couple other things I'd add to that is if your organisation is starting to work on or has already implemented risk champions across the organisation, I would extend that. I'd turn that and tweak that just a little bit and make it risk and resilience champions if you haven't. They're a great way to kind of get that level of, I guess, momentum in terms of buy-in across the organisation that, yes, this is an exposure that we are exposed to, and yes, we're going to have to deal with it. It can really help you build really good networks that becomes critical during a critical event to actually resolve the event, and also connect you into the community because they'll have really strong ties, which is where you'll often be leveraging resources from to resolve an event. And then I think probably the final point on that is build out that capability across those across those stakeholders as well. If you have risk and resilience champions, and historically I'd always say, yep, get your crisis simulation going once a year and do your big bang, and I'd always advocate to do that. And I think to Thomas's point, get an understanding of your exposure, dial up a big scenario, absolutely. Probably extending from that though, where my thought has now gone to watching this happen with COVID in the background, is do that. That's going to probably tick off your senior management and your exec team about dealing with a crisis. But start thinking about more, and we talk about it in the terminology we use as micro simulations. Start peppering those risk and resilience champions at a lower level to get some risk awareness up around a tiny little bite-size scenario. Literally take 10 minutes out of their quarter to think about these things. You get a light bulb moment and start them thinking about how do we actually get ahead of that scenario and then essentially resolve much faster. But like I said, I come from a very much probably an immediate, how do we respond and get better at responding? Thomas, from your perspective, I'm interested.
Yeah, so I mean, obviously the changing landscape of regulation is certainly one. It's a very fast moving space. If you haven't already, get familiar with TCFD, because that is certainly going to be the framework moving forward that the regulation is going to be based around. Even not in the financial services sector, it is the standout example. I'd also say, you know, as I mentioned previously, understanding that climate data and climate modelling moves very quickly. There's improvements in the capacity, the computing power and the accuracy of these models through time. So they are getting better, resolutions are getting better all the time. The scenarios are changing as well. So I think it's probably also important to be in contact with someone or yourself, being over, you know, what is the latest data that you can use for your business. And then two other points I think is one is around compounding risk, and Marcus mentioned this. At present time, almost all climate and weather risk assessments are undertaken on a peril by peril basis, and there's not that much appreciation or understanding of the joint probabilities that these things happening at the same time. For example, you know, looking at a federal level, if I had a severe tropical cyclone in Queensland at the same time as dangerous bushfire weather in Victoria, how does that play out from an emergency management perspective? And the modelling society, or the modelling group now, community, is moving more towards looking at these perils in correlation, such that we can model the financial losses of these perils occurring in tandem, and how that compounding nature might change with climate change. So that's almost a third dimension to it, which at the moment is not considered, but I think is very important going forward, because we can certainly be underestimating the impact and the financial impacts of these events if we are considering them in isolation. And then finally, I'd probably say on a practical note, if you really want to get a good understanding of climate risk on your business operations, you're going to have to get comfortable with sharing business side data. And this is often a boundary, you know, a barrier that we come up against around data security and privacy. To really get a handle on things, we need to know where your assets are. We need to know what your assets are made of. If you have any historical business interruption data that we could use to correlate against climate or weather variables, then that again will be of use. The analysis is really only as good as the quality of the data that backs it up. And that goes from the climate side data as well as the business side data. So certainly something, you know, data security and privacy have often been issues for us in undertaking climate risk assessments, and that's probably a conversation to be had internally on the business side, I think.
Thank you both for your insights. Unfortunately, we've actually run out of time, so I don't think I've left enough time for any questions, but please feel free to sort of send through any questions and hopefully we can answer them. I might just wrap up by saying thank you very much, Marcus and Thomas, for your insights today. I feel like I've even learned a lot from that. And just to sort of wrap up, just to remind you to fill out the feedback form after the webinar, and to also remind you from Jason's comment that there's complimentary access to the platform for you as members. Okay, so that's it from me. I don't know, Marcus or Thomas, you've got any sort of final comments or that you wanted to make?
Yeah, absolutely. I'll just reiterate, thank you very much for your time, everyone. We do have a Lumina up and running and available for RMIM members, and I'll just give you a quick insight into what my world looked like this past week with a patchwork quilt of threat data coming through for flood. That is available. You're going to get a follow-up note from RMIA around access to Illumina. It is free. Feel free to get in there and leverage that. It is all around getting good data against these exposures in real time for your own risk management purposes. But thank you, and thank you, Penny, and thank you, Thomas.
Yeah, I'd just like to say thanks very much for the invite today. It's been a really timely session, a very interesting one. And certainly if there are any questions afterwards, certainly happy to respond via email to any that might pop up.
Great. Thanks, everybody.
Thank you very much.
Thank you.